Another day, another new high in the Nasdaq, and a lot of interesting markets going on today in the futures. Gold and even the oil markets there are starting to rebound here as well.
Certainly, Mike. As always, always looking forward to join you. And yeah, we got a market that just can't stay down. I mean, every time we have something that puts it under a little bit of pressure, it seems to bounce right back, and we're knocking on the highs right now. So, yeah, should be some good information here to go over when we try to connect these markets to the futures.
Absolutely right. And because this is an introduction class, we definitely welcome your questions. So please feel free to type in your questions just below your viewer, and we'll get to those questions once today's presentation has completed. We'll leave a few minutes at the end there to get to your questions. But before we begin, we do want to note that futures trading is offered and positions are held through Charles Schwab Futures Inc., which is a separate but affiliated company of Charles Schwab Incorporated. Now, futures trading does involve substantial risk and may not be suitable for all investors. So if you're interested in trading futures with us, we do ask that you please read the risk disclosure statement for futures and options. So let's talk about what we're going to discuss today. Since this is the introduction course, we're going to do the definition of a futures contract. Then we'll talk about some of the terms and features that everybody who trades futures should learn about, such as the specifications for the futures contracts we offer, how do the expirations work, as well as the settlement process. We'll also discuss trading symbols, and because they're a little bit different in futures than you're used to in equities and options. So we'll go over how a future symbol is created, and we'll talk about some terms such as tick movements, how leverage works in futures, as well as the difference between how margins is considered in futures between that and how it works for equities. So let's begin by discussing the definition of a futures contract. And really all a futures contract is, it's a legal obligation to buy or sell a particular asset. It could be a commodity, let's say like corn, or it could be a financial instrument, such as, let's say, a treasury bond, at an agreed upon price today, but for delivery in the future. Now, what's unique about these contracts that we all know about here is that the terms are standardized so that any party trading these contracts knows, for instance, the quantity of the contract. If it's a deliverable contract like corn, they know what the quality is, such as number 2 yellow corn. Is it physically delivered? Where is the commodity being stored, as well as the date that the delivery can actually take place. Another unique feature that adds a lot of liquidity to these markets is that these contracts are backed by the exchange clearing firms. And why is that important? Well, it eliminates counterparty risk. And for instance, let's say that I'm a wheat producer, and let's say Joe here owns a flour mill, and we work on an agreement between each other that when the harvest comes in July, I'm going to sell Joe 10,000 bushels of soft winter wheat he's going to make into flour. Well, let's say that we have a bad winter, we had winter kill, and my crop was heavily damaged. I don't have 10,000 bushels of wheat to supply to Joe. Well, I'd have to then go back to Joe and try to work out a different agreement, or maybe try to, get out of my contract, but Joe still needs that wheat. So we got kind of a problem here. But by trading in the futures markets, if I had an issue with fulfilling my contract there, I could just close out that trade with another party, and Joe could still remain in his contract and still get his wheat that he needs at expiration there, and we don't have any issues there. So that's one of the things that adds a lot of liquidity to the contracts, and you don't have those issues that you see with counterparty risk like you'd see in, let's say, a forward agreement, which is negotiated between two parties. Now, Joe, maybe you could discuss like who actually trades in the futures markets.
Certainly, Mike. So you touched on it there a little bit with your your wheat example. Someone would ask themselves, well, why do you want to know what the price of some commodity will be at some fixed point into the future? Why don't you only care about what it's trading today? Well, in the example you laid out, the wheat farmer, he's going to have his crop, but at some point in the future. And the miller who needs to get the wheat to grind it, he only has a need for that down the road. He doesn't need it right now. They're fixing their prices out into the future when they have a need either to use it or to sell it. In the interim, they both have risk. price, like you said, there could be a weather event that makes the crop, your crop, less than desirable, but that will drive up the price because supplies will shrink, and that will expose the processor, the user, to upside risk. So likewise, a bumper crop from ideal weather could put prices down because supplies will be up, and that hurts the farmer. So both of these people have price risk, and they're trying to achieve something called price discovery or price insurance by using futures contracts listed by the exchanges. Now, we like to call these people's hedgers, right? They're hedging their risk, whether they're a producer or a user. They use futures to hedge their risk over the term until it reaches maturity. In the interim, there's a third group. We call them speculators, the retail investor, the majority of you listening to us now that are going to trade futures. You come into the market with not necessarily any relation with the cash product whatsoever. You have an opinion, right? You may think crude's going higher or gold's going lower or corn's going higher, and you can act on that by buying and selling futures contracts. And by doing that, you are providing liquidity to the market so that these hedgers, this wheat farmer and this wheat miller, they don't necessarily have to arrive in the marketplace at the same time, because the speculators provide the liquidity that allows others to get in and out of the market at favorable margins between bid ask all the time.
Right. So it's really the combined by having both parties there, for instance, the speculators and the actual end users there, is what adds to the liquidity of the markets, because there are a lot of commodities that the exchanges come out through that was to try to fulfill a need for maybe hedging purposes. But if you don't generate that speculative interest, it's really hard to get enough liquidity there to really make it worthwhile. So good, successful futures market has both a need for hedges as well as enough price movement there that's going to attract the speculators as well. Now, let's talk about some of the specifications of the contracts that we offer for futures. The first and some of the oldest contracts were done for the agricultural sector, for instance, the grain markets. The first contracts traded at the Chicago Board of Trade in 1848 were grain futures. I think it was actually a corn futures contract, if I'm not mistaken, back in the day. But we offer a whole grain complex of corn, wheat, soybeans, rice, and oats, as well as a livestock sector, which came in, I think, in the 60s they started doing, or 70s they started doing livestock futures contracts such as lean hogs, live cattle, and feeder cattle. For those that don't know what feeder cattle is, it's really just young cattle that's placed on feedlot to be brought up to weight to be then sent to the meat packers. We also offer our food and fiber category, or what's known as the softs in the industry. Those are some of those tropical commodities you hear about, such as coffee, cocoa, sugar, cotton, and for those of you who've seen the movie Trading Places, frozen concentrated orange juice. We also have a very active energy complex where we have crude oil as being the main contract there. And we offer two different varieties of crude oil futures. We have what's called the WTI, or West Texas Intermediate Crude, which is the benchmark for U.S. production of crude, as well as the Brent crude futures, which is kind of the benchmark there for the international crude trade. We also offer some of the refined products of oil, such as gasoline and heating oil, as well as the natural gas futures contract. We didn't have it here on the slide, but we also have a very active metals futures contracts as well too, such as gold, silver, copper, platinum, and palladium. Joe, maybe you can discuss some of the financial contracts that we offer.
Absolutely, Mike. So everything that you just touched on are what we call the old school tangible commodities. You physically have a commodity that you can see, touch, feel, and trade. Back then in like the 1980s, the exchanges realized that there actually is a similar type of risk out there that investors may want to have an instrument that allows them to hedge risk or speculate on some of these less tangible, what we call financial instruments. And as you can see, the categories make sense. We got interest rate products, treasury bonds, treasury notes, euro dollars, the T-bills, which were big back in the day, Fed funds, all of those of different durations, currencies. You can hedge your risk in currencies. For instance, British pound. Let's say you have a company that produces a widget here in the States and you sell it in the UK, you get paid in British pounds. Well, if you're expecting a big payment in September in British pounds, you have some risk on that conversion to US dollars from now until September. You can hedge that risk just like the corn farmer by using British pound futures. And then down at the bottom there, indices, those are the big ones. You've all heard of the E-mini S&P futures contract, the most actively traded futures contract in the world. And you could use that to hedge your portfolio. We'll talk about that a little bit later when we touch on notional value. But yeah, the financial products have really taken hold once these exchanges realized the value in offering them.
Exactly right. In fact, I think on the CME group there as well, the financials by far offer the vast majority of trading is done in the financial futures currently. Now, how do you find out what futures contracts are available? Well, I brought up the slide here, but I'm actually going to bring up the Street Smart Central platform, and I can show you there directly how you can find any of the futures contracts we offer. There's a couple places. One of them, if you go to quotes heading, and then go to our quote detail page. This is a very popular page, and we'll be using that a lot in today's demonstration. You can go here to the little hyperlink here that says futures. If you click on that, a little pop-up window appears that has 3 drop-down menus. By using these 3 drop-down menus, you could find any of the futures products that we offer, as well as any of the expiration months available for that contract. So the first one is the market. So what we've done here is we categorize all of our futures contracts under a certain market category, where they would fit in. So for instance, indices, energies, interest rates, currencies. Let's say, for instance, we're interested in trading cattle futures. We could look through the category here where we most likely find cattle futures, and we'll go to livestock futures because we'll probably find cattle futures there. So then once I have livestock futures selected, we can go to our select products drop down, and I'll show you all the futures markets under livestock futures that we offer. So we have feeder cattle, lean hogs, and live cattle. Let's say we want to trade the live cattle futures. We can then go to our expiration date drop down, and then we can see all the expiration months that are available. So we have contracts currently that expire this current month in June 2020, and currently going out to October of 2021. Let's say we wanted to trade the August futures. And once we selected that, we could click the select button, and it'll populate here a current quote for that contract. So we can see the last traded price, the day's change, the percentage change, the bid in the market and the offer, open, previous close, high, low, volume, as well as a little extended quote here as well. So you can see the days range and volume and open interest. For those that don't know what open interest is, it's just the number of contracts that have traded that remain outstanding. And then we'll go into these details a little bit through our presentation today, but you get really a wealth of information for any of the products that we trade. There's one other place we could find those particular contracts, and that's on our contract specifications page. So we could find it under research, futures research, and through our quick links drop down, it's the first link there called contract specs. And here you can find the root symbol for all the markets that we offer. So we have a couple different ways where you can find any of the futures products that we offer. So let's go back to our slides here. And let's talk about the size of the contracts. So unlike equities where the standard round lot is 100 shares, for futures contracts, the size of the contract really vary depending on the product that you're trading. So for instance, corn futures, the contract is 5,000 bushels. A contract like our lean hogs is 40,000 pounds. Coffee is 37,500 pounds. Crude oil is a 1,000-barrel contract. Contracts like gasoline is 42,000 gallons, and natural gas is kind of a unique one. It's 10,000 million BTUs. On the financial side, when you're trading the treasury bonds, you're trading $100,000 face value. A contract like the British pound is 60,500 pounds. And our E-mini S&P 500, which is by far the most popular contract traded by our clients here at Charles Schwab Futures, it's $50 times the S&P 500 index. Now, where can you find this information? You find that on that details page on that contract specs. That's probably the best place to find it. So let's go back to that page here. Quotes, quote detail. And let's go back to our cattle future example. LCQ20. If we look down here at the contract size, we see that as a 40,000 pound contract. So that is probably the easiest place to find it, but you can also find it in that contract specs page we looked at earlier. Now, let's talk about some terms that traders will need to know is whether a contract is what we call physically delivered or cash settled. Joe, can you discuss how physical delivery contracts work?
Sure, Mike. So for some of our listeners that are new to futures, you might be familiar with, let's say, expiration dates when trading equity options, right? Well, futures, we're trading something that's dated into the future. And as we approach that maturity date, there's a couple of important scenarios that can play out. If you're trading one of the old school type commodities that we referenced earlier, the physical ones, the corn, the crude, the tangible products, many of those are what we call physically delivered. So when you enter into this contract, this futures contract, this obligation to buy if you're a long or sell and make delivery if you're the short, it goes through a physical delivery period. And that period is designated with something called first notice day. And all that means is from that date moving forward, and it's generally about 3.5 weeks before you get to the last trading day of the contract. Depends, some of them are slightly different than others. Within that period, from that first notice day on, you can receive a notice of delivery, meaning if you're a long, you would receive a receipt for a warehouse delivery of the contract itself. Now, it's not something that we would recommend to any of our clients. In fact, we don't allow it to happen. We have measures in place to protect you from this happening by sending you some communications in the days leading up to this first notice day to kind of give you a heads up and say, hey, you know what, you're long some corn. It's going deliverable on this date, and we'd like you to roll out of the position or close the position 3 business days prior to that date to protect you. Because as you'll see when we look at some of the volumes and open interest later, as you get into delivery, you're not the only one who's being advised to get out of the position and roll into the next month. So are all the other investors. And what happens is it becomes a thinner, less liquid market. And that's nowhere anyone wants to be as you approach the last trading day. So again, physically delivered products, commodities have a set calendar in place. And at Schwab, we will inform you, educate you, and communicate with you to make sure that you are aware of it and take steps to avoid having to go through the physical delivery process.
Right. The other type of settlement there is what we call cash settlement. And how this works, this is very popular, especially in a lot of the financial futures contracts, but also some commodity contracts have now moved to this cash settlement process. And how that works is at the end of the contract's life or the final day of trading, contract holders are either debited or credited the difference between their initial entry price in the contract and the final settlement price that is determined by the exchange rules for that particular contract. Even though there's no chance of being physically delivered on the contract, most of those contracts are also closed out prior to that settlement period as well. So a good example of a cash settled contract is something like the E-mini S&P 500. That's probably the one that I think most traders know as a cash settled contract. Now let's talk a little bit. In fact, Joe kind of talked about this as some of the other important dates that all futures traders should know. Since you talked a little bit about the first notice day, Joe, obviously it's the first day that the exchange can sign delivery to an account that's long the futures contract. And like Joe was saying there, we don't allow our traders here to take physical delivery of any contracts, and we do ask that they close it out 3 business days prior to that first notice day period. And we do send emails out to clients notifying them that this day is occurring. And the other date that's really known is the last trading date, and that's pretty self-explanatory. It's the last day that a contract can be traded before either delivery takes place or cash settlement will occur. And once again, there are notifications out there to let you know when those dates are occurring. Now, Joe, maybe you could talk a little bit about how expirations work for futures contracts. Like, how are the dates determined and what months are available?
Yeah, so Mike, again, trying to compare to what some of our equity traders may view when you look at an option chain on equities and you see the different expirations, the weeklies, the monthlies, the
In fact, let's
quarterlies.
pull that up now, actually. Let's pull up, actually, it's a go-to called the
Yeah,
futures chain here. We
because a lot, like if you look at
could
the
show that here.
financial products like the E-minis, uh, they have very simple financial quarters: Sep, Dec, March, June. Those are easy to recognize, easy to see. But many of our other products have unique expiration months that have developed over the years that are specific to that commodity's, its unique characteristics. Some of the more unique ones are agriculture's up there, and you can see that the July chronologically on top. That's our first month, and it's got pretty good volume, 99,000, and open interest of 136. But if you go down the next few months, the second one there, August, then you got SU20 as SEP, and then you got a fourth one there, SX20, which is November, and it has pretty substantial volume. In fact, it's more than the July, and the open interest is the greatest. And you might look at that and kind of scratch your head, and why is this November one got more volume than the front month, the spot month, the cash month? And that's because unique to this particular commodity, agricultural, that represents the new crop soybeans that were just planted 2 weeks ago. And those are going to be harvested in October. So people will use the November contract to hedge the new crop. So it garners the bulk of the volume. Now, we did have a lot of volume in the July, the last few weeks. But if we take a look, Mike, on the July itself in quote detail, if you just click on that SN20, you'll see that July is nearing that delivery period that we just referenced. And if you look, first notice day, 6/30/2020, that's in a week. So 1 week from today, if you're a long contract holder in July soybeans, you are running the risk of having those beans delivered to you. So this is where people are encouraged to start to get out and either close it in its entirety or roll it into the next month. And that's why you see volume filtering out of July into September and August and even out into the new crop November.
And actually ties into one of our questions here from BJ in New York. It's what happens if you miss that notice of delivery and don't close a contract? Well, here at Schwab, we have a process in place that will normally roll forward that contract to the next most active month out. There's times though where we may have to liquidate the contract instead of roll, and it's usually, for instance, if your account is on what's called a margin call, where you don't have the current equity to hold the rolled position, or in an extreme case where there is very little liquidity in a particular contract, it may be very difficult to roll it forward, and then we may have to take action to liquidate it. But we'll either mostly roll forward, but occasionally we'll have to liquidate those contracts prior to the delivery period taking place. So very good question there. Now let's go back to our deck here, Joe, and let's talk about where we can find the settlement information. Once again, on that quote detail page, kind of highlighted there. Let's talk a little bit about trading symbols. Now, future symbols are made up of three parts. The first part is what we call the root symbol. Now, all of our futures contracts have a unique root symbol associated with it. Normally, they're alphabetic, however, some contain numerals, and they're between 1 to 4 characters in length. I gave you an example here on the far left. There are some of the more popular products and what the root symbols are, such as WTI crude is CL, gold is GC, the E-mini S&P 500 is ES, copper is HG, corn is C, wheat is W. So that's the first part of a future symbol. The second part is the expiration month. Now, the futures industry has assigned certain letters of the alphabet to the 12 calendar months. As you can see in that little middle box there as well, for instance, the letter F stands for January, J is for April, Q is for August, X is for November, Z is for December. So you look at that and it's like, how do they come up with these letters for the various months? And there's all kinds of stories out there about how they occurred. One that I heard was that back in the days, that was one row of the old teletype machines that they would the key punchers would end to price the quotes in. But I think it's kind of lost to the ages about how these came about. But one thing about these letter codes is that they are pretty much industry standard. So no matter where you get your futures quotes from, or if you trade on another platform, pretty much all firms will use these particular letters to represent the 12 calendar months. And finally, the expiration year of the contract. Now, this can vary depending on where you're seeing your quotes. So we use the last 2 digits of the year. And the reason we use 2 digits as opposed to 1 digit, like you may see in some other quote providers, is we now have futures contracts that go out expiration 10 years in the future. So we don't want our customers to get confused between an expiration of a 2020 contract and a 2030 contract. So to make it, make sure there's no doubts, we use the last 2 digits of the expiration year. So all those 3 things combined make up a futures symbol. Now let's talk a little bit about the platform that you trade futures on. That's called the All-in-One Trade Ticket. Now, Joe actually does a demonstration of the Street Smart Central platform. I think it's coming up on Thursday. We have one. Is that correct, Joe?
Yeah, Thursday, 4 o'clock Eastern, myself and Kevin Green will be giving an in-depth walkthrough of the platform, specific to the actual mechanics of the platform, some of the bells and whistles, some of the shortcuts that we know that will be helpful once you get started. So I encourage anybody that's been recently approved for futures trading or is at a minimum able to use Street Smart Central to tune into that broadcast. Have your Street Smart Central platform open during the discussion, and I think you'll find it very helpful.
Right. So they'll go into more details about the whole platform, but I just want to kind of highlight the tickets, the all-in-one trade ticket to be trading it on. And there are 4 types of futures trades you could place here on Street Smart Central. You could place an outright futures trade. You could also trade futures options. Yes, there are options on, I think, almost 50 different futures contracts that we offer. We currently offer options trading on, including actually a lot of the contracts also now offer weekly options as well, too. So just like you're seeing in the equities, the weeklies, you can trade a lot of the market's weekly options on futures as well, too. Then we have futures option spreads. So any kind of futures option spreads, for equities, whether it's call spreads, put spreads, calendar spreads, straddles, strangles, any 2-legged type of spread you could do in equity options, you could also do in futures options as well. And then there's a 4th type of order, and this is kind of unique to futures. You don't see this in the equities markets, and that's a future spread. So Joe, maybe you could talk about what is a future spread and why would you do this kind of this trade?
Well, absolutely, Mike. So if you look at that screen you have up right now, you can see that this order ticket is buying a September E-mini future and it's selling a December, the letter Z. So at the same time, this order is buying a SEP and selling a DEES. Well, why would someone want to do that? Well, imagine someone was short the E-minis. Maybe they don't want to be short them today, but imagine someone short an E-mini and we're approaching September and they want to maintain their short exposure. So they're going to buy back that short September and sell and open a new short in December at the same time. So they're using the spread ticket to roll their position. We talked about rolling earlier with regard to physical delivery products, but people will roll their exposure in a cash settled product as well. And if you look down there underneath the duration order, you see current spread differential is 9 to the buy side. So it's always going to be quoted to the greater side here. We've got the September is currently trading about 9 points over the DEES. So if you were going to execute this spread, you would be a buyer of something around 875 or 9. Now, that's where you're using a spread to actually move a position. So you're actually closing one and opening another. There are people that will actually open 2 positions from scratch. They don't have anything on, but for instance, a soybean trader, if you want to go back to that, someone may want to have exposure in the near term July soybeans. Maybe they think there's a shortage of near-term supplies and the cash market may drive up the front market futures. And then on the same token, they think that the crop that's in the ground is bigger than people think, is going to have beneficial weather, is going to have great yields, and it's going to pressure the price of the new crop SX November. So in that case, this person would want to put on this spread, which by the way is a very, very popular spread, where they are buying July near term, selling the November new crop as a spread. And this, they're playing the spread itself as of an investment, right? You're looking at that current spread differential. It says it's 1 to the buy side. That means July is trading one penny above November. And this person, by doing this spread, thinks it's going to, what we say, widen. They think that July may go from 1 over, it might go to 10 over, and they would make that 9-point difference. So yeah, spreads are very, very common, something a little foreign to our equity listeners, but a big part of futures trading.
Correct. Yes, there's a lot of different strategies that can be done with future spreads, and in some cases, the exchanges will also allow reduced margin requirements, which we'll talk about a little bit, for doing a spread as opposed to an outright futures trade. So let's go back to our slides here. And now let's talk about tick movement, leverage, and margins. So tick movement, all a tick is in the futures parlance is the minimum price fluctuation that a futures contract can trade in. That's known as a tick. Now, the size of the tick and the value of the tick on a futures contracts will vary depending on the contract that you're trading, and those are all set by the terms of the contract by the exchange. Here's a pretty straightforward example. We talked a lot about the crude oil futures contract. We talked that it's a 1,000 barrel contract. Now, the tick size, it trades in increments of 1 cent per barrel. So if we wanted to calculate what is the value of that tick for one contract, we would take the contract size, multiply it by the tick size, so 1,000 times 1 cent, we come up with $10. So the minimum increment for crude oil futures is 1 cent per barrel, which is worth $10 per contract. So for example, let's say I bought crude today at $40 a barrel. If the price of crude went from $40 to $40.01, and I had one contract long, I would make $10 on that. Or the other example, if I was long one crude oil contract from $40 and the price went down to $39.99, I would lose 1 tick or 1 cent per barrel, and I'd be down $10 on that contract. So that's just how it works. And all this increments there is all calculated. Once again, on that quote detail page, we show you not only the tick size, but also the value of that tick size. So you don't have to do the math yourself. It's already calculated for you. Now let's talk a little bit about leverage. And Joe, I don't know about you, but when I talk to clients about futures, either clients are very excited about the amount of leverage that they can have, or I hear that maybe some clients are maybe a little hesitant to explore trading futures because of the amount of leverage that they have, and they think it adds added risk or could be risky. So it's really kind of a two-edged sword how that works for leverage. And how leverage really works is it's you only have to put up a small percentage of the full contract value, or called notional value, for a contract to control a particular futures contract. Now, the exchanges set this amount that is needed per contract, and they could change that depending on the market volatility that you're seeing in a contract. So if a contract becomes very volatile, like we've seen in the crude oil market a few months ago, when the price went down from like about $40 a barrel down to a negative $40 in only a couple of days' time, they may actually increase the amount of money that you have to deposit to control the contract. But if you go through a time, let's say, maybe the grain markets in the winter when prices are kind of quiet, they may actually lower the amount of requirement needed to control that contract, because price volatility is a lot lower than it has been. So Joe, maybe talk about the example here of crude oil and how that kind of works as far as the leverage here.
Absolutely, Mike. So that dollar amount that you are referring to, that the exchanges require you to have on deposit in order to execute a futures contract, within the industry, that's called the margin requirement. We're going to explore that a little deeper on the next slide. But when we're talking about the leverage and the notional value, we could take this example right here. Now, granted, these prices are a little bit dated with oil at $65 a barrel, but for the discussion, we can look at that contract size of 1,000 barrels and know that one contract has a value, a notional amount of $65,000, right? Simply just the contract size times the current price. And back when this slide was put together, the exchange required $2,600. So the leverage you're getting is tremendous when you think that you can control $65,000 of something by putting up 4% of it, or $2,600. Now, that number, and crude oil in particular, those have changed dramatically because of what you just referenced, what happened a few months ago. The exchanges raised those requirements substantially. But something to note, every commodity is different, and each one has, because of its own unique pricing characteristics and its the exchange's perceived volatility levels at that moment in time, each has some amount of leverage that you can do the math on and figure out, but they're all very, very substantial. And like you referenced earlier, people that are new to trading with leverage should be concerned, and should be cautious, because as great as leverage is, it can come back to hurt you when markets start to move the wrong way.
Exactly. It leads to not only potentially outsized gains on the amount of money that you're depositing on the contract, but it could also lead to outside losses as well. In fact, you could actually even lose more than the initial amount you deposit on a futures contract. So it's definitely that two-edged sword there as well, where it could lead to outside gains as well as outside losses, including more than you initially put up. So that's just how leverage works. And when we talk about this leverage amounts, these are the minimum amounts that the exchanges require. So for some products, if the firms could also maybe increase the amount of requirement as well too, in other words, lower the amount of leverage, especially when markets become volatile. Traders as well too can also kind of alter the leverage you're using, so it's less leverage than the exchange minimum by just depositing more money in their account to control the contract. So there is a little bit of control on the leverage, but when we're talking about the minimum amounts here, that is the exchange minimums, and they cannot be lower than that. Now let's talk a little bit about the margins. Now, Joe, you talk to clients every day, and you talked about equity clients and derivatives clients as well too. So maybe you could explain how you discuss to a client the difference between margins when it's talking about equities as well as margins when it comes to futures.
Absolutely, Mike. So yeah, the term margin gets thrown around quite a bit here in the investment discussions, and many of you are probably very familiar with the meaning of margin when it comes to trading equities, particularly when purchasing stock and borrowing from your firm, borrowing on leverage, purchasing more shares than the cash on hand to buy in your account. When we refer to margins with futures in mind, it has a much different meaning. The word margin in this sense, by definition, is the amount of settled cash that needs to be in your account for each one contract you want to buy or sell. What that means in more common terms is it's the good faith money, it's the cushion money that you need to have in your account based on the exchange's perceived level of volatility. You need to have that money in there to protect you in case it starts to move against you. That's why more volatile markets, they're going to ask for more money. Less volatile, less. They ask for what we call initial margin. And like the name denotes, initial margin is how much you got to have initially when you put your first buy or sell on and take it home overnight that first night. After that, going into day two and beyond, your margin requirement slips about 10% and goes to what we call the maintenance level. And you need to keep that amount of money in your account in order to hold your open position. If the market goes in your favor, you're fine. If the market starts to move against you and your account value dips below the margin requirement, you'll get a margin call, and then you're required to deposit funds, transfer assets, or liquidate positions to bring your margin requirement, the cash on hand, back to the initial, not just back to maintenance. So if you dip below maintenance, you got to go back to initial. But again, these levels are determined by the exchange. Every brokerage firm has to have those at a minimum, and most brokerage firms put a little bit more on based on their own risk department's outlook on certain underlyings and how much they're going to move.
Absolutely right. So yes. So yeah, that's part of the thing about margins is just know that it's not a loan like it is for equities, but it's
Right.
just the the minimum you need to control the contract that you established. So let's open up some questions. If you have any questions now, please do type those into the question window below your viewer. And we do have some questions here. We'll start with is the first one here is, do you need any special clearance from Schwab to trade futures? That's actually a good question. Now, in order to be eligible for trading futures, is first you have to have a margin account with Schwab. If you have a margin account and it's an account that's eligible for trading futures, you'll be able to go to the future section on schwab.com, which I think Joe maybe shows when he talks about the StreetSmart Central platform about how you can apply for futures. And then it tells you if you're eligible. If you're eligible, there's just a few short questions that needs to be answered there. They're going to ask some criteria about trading experience, as well as some income, occupation, net worth and all that. And then once you fill out those criteria, then you'll know right away then if you're approved for trading futures. So it could be done really within just really almost a few minutes if you're approved or not. So, but yeah, you can just do it all through the schwab.com site. And like I said, the margin requirement, having the margin account though, is one of the things that is required to be eligible to trade futures. Here's another question, Joe. Maybe yes.
Yeah, one thing just to follow up with that, just to clear up any confusion, but the IRA accounts are not eligible. We've had a number of clients call in and ask that. So only taxable brokerage accounts, but certainly joint accounts, trust accounts, certainly you can do it, but no IRAs.
Very good point there. Who is the smart money in financial futures? Is it dealers, asset managers, leverage money, or other reportable positions? That's a really good question there, because I think you probably ask different people, you get different determinations. When they talk about the breakdown for who trades these futures, they call them the non-reportables, which are the smaller speculators. They have what they call the non-commercials, which is the kind of your hedge funds, your asset managers, professional traders, and then you have what they call the commercials, and those are people that usually use the futures markets for hedging purposes. I know in the grains they talk about the commercials being the smart money. As far as the financials, it could be the commercials, it could be those those leverage funds, the asset managers. But I mean, lately though, if you talk about like the stock market, it seems like it's the small traders there that have really been the smart ones, as they've been kind of buying this rally here, and it's been the professionals there have kind of stat it out though. So it's really, I guess, to your interpretations, but I think traditionally they would say the non-commercials, your asset managers, your hedge funds, are considered quote unquote smart money.
Yeah, Mike, I also think, sorry, just to add to that, I also think that those three different categories of, commercials, retail investors, and funds, they all have different characteristics depending on the market they're in. There's a school of thought out there that the retail investor in many ways is considered what we call weak hands. And what that means is if the market starts moving against them, they're going to be the first ones to get out, right? Whereas a commercial, because he's got exposure in the cash product, he's not necessarily considered a weak investor. He can withstand a move against his position because he has the opposite position in the cash market. And then the funds, these funds tend to operate a lot with signals and algorithms, and those people tend to move in unison when they hit a certain price point. When something triggers, they all trigger at the same time. So if you hear that, the funds are all short this, and there's a big number coming up here, and if this happens, they're all going to get out. And you can have what are exacerbated moves when the funds all get out. But those characteristics are just, general schools of thought within the industry, but each market is unique in itself.
Very good point. Now, is StreetSmart Central the only platform for trading futures? Currently, it is the StreetSmart Central web platform, as well as we have a mobile platform as well too, called StreetSmart Central Mobile. So you could trade both web and mobile for trading futures. But right now, futures are not available, let's say, on StreetSmart Edge or on schwab.com. Okay, let me see if there's any other questions here. We talked about how airlines also utilize the futures markets to hedge their fuel prices. And yes, the airlines do. They usually use something that's kind of a middle distillate. There's no jet fuel futures currently trading. So something like the heating oil or ultra low sulfur diesel kind of act as a surrogate for hedging that middle distillates like jet fuel there as well too. And there's a lot of airlines that do use the futures markets for hedging purposes. Okay, it looks like that's all the questions we have today, Joe. Definitely glad that we had our viewers and got some good questions from our viewers here as well too. And I definitely recommend you sign up for Thursday's class there with Joe and Kevin Green and learning more about the Street Smart Central platform there as well too. So they do a great job going through all the tools and features available for our futures traders on Street Smart Central. So Joe, thank you for joining me today, and we'll talk again in a couple weeks.
Always a pleasure, Mike.
And for our viewers, coming up next at the top of the hour, we have today's option market recap, and that'll be with Nathan Peterson and Randy Frederick. So definitely stay tuned to see what's going on in the options markets today. And for those who want to learn a little bit more about futures or what's going on in the futures markets, I'll be on with Lee Bull on Charting the Markets on Thursday at 1 p.m. Eastern, and we'll discuss more about the futures markets then. So once again, I want to thank everybody for joining us today on our Introduction to Futures class, and I want to wish everyone a great trading week. Thanks for joining.